Warren Buffett, a name synonymous with unparalleled investment genius, has consistently outperformed the market for over 5 decades. The man, fondly known as the Oracle of Omaha, has fascinated the world of finance with his exceptional prowess and astute investment strategies. His company, Berkshire Hathaway, stands testament to his proficiency, with its stock price skyrocketing more than 300,000% since 1965. Unbelievable, isn't it? The secret to this phenomenal success isn't an enigma, but a set of core principles that have guided his investment decisions throughout his illustrious career. These principles have not just shaped his investment strategies, but have also made him a living legend in the world of finance. If you've ever wondered what's behind this man's extraordinary success, buckle up as we explore the top 7 investment rules that have shaped Warren Buffett's career. The first rule in Buffett's playbook is simple yet profound. Invest in businesses, not stocks. This principle is the bedrock of Buffett's investment philosophy. When he looks at a stock, he doesn't see just a ticker symbol or a price per share. He sees a piece of a business, a share in a living, breathing entity with its own operations, products, and services. It's about understanding the business, its competitive advantages, its market position, and its potential for growth. Buffett believes that truly grasping a business's fundamentals is the key to making wise investment decisions. It's not enough to chase hot stocks or jump on bandwagons. It's about digging deep, doing the homework, and investing in strong, well-run businesses that are poised for long-term success. So when you're about to invest, remember to look beyond the stock ticker and into the business itself, just like Buffett. Buffett's second rule might sound counterintuitive: be fearful when others are greedy. This contrarian approach has been one of the cornerstones of his success. When everyone is buying, prices are often inflated, and when everyone is selling, prices are usually undervalued. This creates opportunities for savvy investors who dare to swim against the tide. Consider the global financial crisis of 2008. While most investors were paralyzed by fear, Buffett saw it as a golden opportunity. He invested billions in companies like Goldman Sachs and General Electric when their stocks were at rock bottom, and these investments ultimately yielded substantial returns. Or take the dot-com bubble of the late 90s. While others were pouring money into internet companies with no profits to show, Buffett stayed away. He was criticized for missing out on the new economy, but when the bubble burst, his caution proved wise. And then there's the recent COVID-19 pandemic. While many investors panicked and sold off their stocks, Buffett calmly made strategic investments, demonstrating yet again the value of his contrarian approach. But remember, this rule is not about being contrarian for the sake of it. It's about understanding market dynamics, recognizing when fear or greed is driving prices, and having the courage to act accordingly. In the face of market hysteria, maintaining a cool head like Buffett could be your ticket to investment success. Rule number 3 from Buffett's investment Bible is always maintain a margin of safety. This principle is all about creating a buffer between the price you pay for a stock and its intrinsic value. Imagine it as a safety net, ready to catch you if market fluctuations cause the stock's price to fall. Warren Buffett is a staunch advocate of this rule. He understands that the market is not always rational and that stock prices can deviate significantly from their actual worth. By insisting on a margin of safety, he gives himself a buffer against these market volatilities. So how does one establish this margin? It's not an exact science. It requires a deep understanding of the company, its financials, and the overall market conditions. You'll need to assess the stock's true value and ensure you're not paying more than that. By always insisting on a margin of safety, Buffett ensures he's cushioned against market uncertainties. Buffett's fourth rule echoes the age-old wisdom that patience is a virtue. This adage has proven to be a cornerstone of his investment philosophy. Buffett's success can be credited to his ability to think long-term, allowing his investments ample time to grow and flourish. His strategy is akin to planting a seed and patiently waiting for it to mature into a towering tree. While the allure of quick profits can be tempting, Buffett steers clear of short-term market fluctuations. Instead, he places his trust in the slow and steady growth of companies that he believes in. His approach is not about making a quick buck, but about investing in solid businesses and patiently waiting for the fruits of his labor. This long-term perspective has allowed Buffett to remain calm amidst market volatility, keeping his focus on the bigger picture rather than getting swept away by temporary market trends. Buffett's investment style is a testament to the power of patience and long-term thinking. The final 3 rules from Buffett's investment manual are no less critical. Don't try to time the market, understand the risks, and invest in what you know. Let's start with not trying to time the market. Many investors fall into the trap of trying to predict market peaks and troughs, buying low and selling high. It sounds great in theory, but in practice, it's almost impossible. Even the most experienced investors rarely get it right consistently. Buffett, on the other hand, prefers a different approach. He focuses on the underlying value of a business, buying when he believes it's undervalued and holding on for the long term. In essence, he's more interested in the business's intrinsic value than in market fluctuations. Next, understanding the risks. Investing is inherently risky, and Buffett is no stranger to this reality. But there's a difference between taking calculated risks and gambling. Buffett's method of assessing risk is grounded in thorough research and a deep understanding of the company he's investing in. He scrutinizes financial statements, evaluates management, and analyzes competitive positioning. It's not about avoiding risk altogether, but about making informed decisions that weigh potential rewards against possible pitfalls. Finally, invest in what you know. This is perhaps one of Buffett's most famous rules. He's a firm believer in sticking to your circle of competence. If you don't fully understand a business or an industry, it's harder to assess its true value and potential risks. Buffett himself has famously avoided investing in technology companies for most of his career, not because he didn't see their potential, but because he didn't feel he understood them well enough. Instead, he's focused on sectors like insurance, food and beverages, and consumer goods, areas where he has deep knowledge and expertise. These 3 rules, while simple on the surface, require discipline, patience, and a commitment to ongoing learning. They're not about quick wins or getting rich overnight. Instead, they're about building wealth steadily and sustainably over the long term. By sticking to what he knows, understanding the risks, and not trying to time the market, Buffett has built an investment empire that stands the test of time. So, what do these 7 rules tell us about Buffett's success? Well, it's clear that Buffett's principles aren't some arcane financial wizardry. They're grounded in wisdom, practicality, and a keen understanding of how businesses work. Firstly, Buffett's mantra to invest in businesses, not stocks, reveals his perspective on value. Instead of chasing trends, he looks at the intrinsic worth of companies, emphasizing the importance of understanding what you're investing in. Secondly, the rule, be fearful when others are greedy, underscores Buffett's contrarian approach. He doesn't let market mood swings dictate his decisions. Instead, he maintains a cool head, capitalizing on opportunities when others are too anxious or too exuberant. Thirdly, the margin of safety rule is a testament to Buffett's risk-averse nature. It's a buffer against the unpredictable, a safeguard that ensures his investments can withstand market fluctuations. Next is the principle that patience is a virtue. In an era of instant gratification, Buffett champions the power of long-term investing. He's not in the game for quick wins. He's there for the steady, compounding growth that comes with time. Lastly, the rules don't try to time the market, understand the risks, and invest in what you know encapsulate Buffett's pragmatic. He doesn't gamble on luck or speculation. Instead, he relies on knowledge, analysis, and a healthy respect for the inherent risks of investing. Taken together, these 7 rules paint a portrait of a man whose success is deeply intertwined with his principles. They reflect a philosophy that prioritizes understanding, patience, and risk management over short-term gains and market trends. Remember, the path to investment success isn't about getting rich quick. It's about being patient, understanding businesses, and making informed decisions. It's about following the footsteps of Warren Buffett,